In commercial, if you know what you're doing, they miss their rent 3 times, you serve them 3 notices, you can lock them out. 6% net yield, fantastic, like it's better than residential, but they don't factor into potential vacancy. The property could be vacant for 12 months. For every 1 new person that comes to Australia, you need roughly 5 square meters of warehousing space to support them. Amateur investors, they chase the shiny objects. They don't actually go deep into the research. A sophisticated investor, they will go deep. The Tenant turned out to be a drug lab.
Today's guest has spent more than 20 years operating in commercial property space at a serious level. So Will Tong has been involved in over 600 commercial transactions with more than 3.5 billion with a B in total deal value. He's held senior roles at global firms like CBRE, JLL, Colliers, LAJ Hooker Commercial, and Cushman & Wakefield. So structuring high-value deals for institutions, developers, and private investors. This is someone who understands commercial property really works, not just buying assets, but structuring leases properly, managing risk, creating upside through execution. Now, as a founder and CEO of Property Lions, Will applies that experience to private investors who want to move beyond residential and understand commercial from a disciplined and strategic lens. Today's conversation is about cutting through assumptions, how commercial actually stacks up, where the real risks sit, and what separates disciplined operators from everyone else. Will, great to have you, mate.
Yeah, thanks for having me.
Cool. I guess I want to learn a little bit more about you and how you got to the commercial space. So how did you get started in the commercial industry, I guess?
Yeah, so fresh out of uni, I got into real estate, and it's quite interesting because when I was in high school, I was really into health and fitness, so I actually wanted to be a physio.
That's crazy, man. That's literally what I wanted to be when I was 18 years old.
Really?
Yeah, I was a PT, and then I wanted to do physio, but I wasn't smart enough to be able to get the high ATARs.
Right, that's what happened to me. That happened
well.
to me because back when I was doing it, it was a TER, right? That's how old I am, right? It's not ATARs, it's TER.
Yeah.
And at that time, I think we needed 95, I think, to do physio.
Yeah, it was pretty high.
Yeah, and I'm like, oh shit, I didn't get it. So I kind of like just stumbled through uni, got my degree in accounting, and then I'm like, geez, I don't want to do accounting.
Yeah.
Like I don't want to spend the rest of my life looking at other people's numbers, right? And then my mum actually suggested, why don't you try real estate? You know, that's you got a good personality and it's a bit more dynamic. And so I said, okay, great, I'll give it a go. So I got a job in the city selling off-the-plan apartments initially. So this was off the back of the City Olympics. So the property market was going for a bit of growth. And I focused a lot in the Piedmont area, so around Star City, because Star City was just built at the time. So Jackson's Landing and all that was coming up and coming. So I did a lot of off-the-plan apartment sales at the time. So I did it for about 18 months. And then I got headhunted by LJ Hooker Commercial to join a commercial property team. So it was about 23 at a time. So I knew I wanted to get into commercial because commercial fascinates me because you're dealing with business owners rather than retail investors. So the conversations are different.
Yeah.
And the potential deals are larger as well. Mm-hmm. And my mentor at the time as well, he was a very wealthy guy. He was worth $300 million. And all he owned was commercial property. So apart from his principal home and holiday home, he doesn't have any resi. It was all commercial. Mm-hmm. And so I met him when I was 19 during university. So when I got into commercial real estate, I knew I wanted to do what he was doing. And so that's kind of like my way into commercial property. So I've been in commercial property market, over 20 years, like you said. And I've dabbled in different aspects of the commercial property space as well, working on behalf of institution owners, private owners, doing a lot of leasing, obviously structuring complex deals as well. So, I've pretty much done the entire spectrum of commercial property. So yeah, that's kind of how I got into it.
And so why do you think that, what do residential investors completely misunderstand about commercial space?
I think the main thing I would say is that a lot of people consider residential versus residential versus commercial, where I think the mindset should be residential plus commercial. And I'm speaking generally. Most property investors, they start with residential because it's easier to understand. It's lower risk. If you're an income earner, you're a white collar job. It's quite easy to borrow money to buy your first couple of investment properties from the bank and things like that.
Yeah.
So you kind of cut your teeth with residential property. But then most people hit a plateau, as you would know.
Yeah.
After the second, maybe third residential investment property, they hit a plateau, the borrowing capacity maxes out, in all these different reasons. And so a lot of these investors get stuck. So if you want to continue to grow, and the only way you can continue to grow is increase your income, or you get in a different vehicle. So a lot of people are going from residential into commercial, not because one is better than the other, it's because they need to keep growing. And if you're maxed out in one area, you have to go to the next area. Mm-hmm. So when I look at myself and a lot of my clients that are getting into commercial property, they typically go through, I always say there's 3 stages, and I don't know whether you agree with me or not, but when you're a first-time property investor, you buy a single dwelling. Maybe it's a house and land package, maybe it's an apartment, whatever. You buy a single dwelling, you collect rent, and you expect a 7 to 10% annual growth. And then you get some equity, you refinance, you buy a second one. That's kind of like stage 1. And then the investors that are a little bit more, I suppose, have a bigger appetite for growth, they might go into stage 2, which is renovations. Right? So they might buy some old house, they spend a couple $100,000 on it, doing a nice reno, new kitchen, new bathroom, whatever, and they might make 10% sort of profit on it, which is great, right? There's nothing wrong with that. I think that's fantastic. And then the ones that want to do even more, they get into development. A typical development, they get into like a duplex development, maybe some small townhouse developments, and et cetera, et cetera.
3 or 4 townhouses, something like that.
Something like that, right? And obviously, I'm talking about sort of a generalization.
Yeah.
Yes, and then, but with residential, that's kind of the ceiling. I mean, you could do some subdivisions and here and there, but that kind of falls under the development sort of umbrella.
Yeah.
But you kind of like, that's sort of the limitation of residential properties. And unless you're like a lend lease or a Mervac and things like that, you're probably only going to be doing smaller deals, maybe up to $5 million in total value kind of development if you're a individual investor. So a lot of clients that I work with at the moment, they've kind of done that. They've done the single dwellings, they've done some sort of value add residential renovations, and they've done some small scale development. And then they kind of go like, what's next? Right? What else can I do? And then they start looking into commercial, and then they realize, well, in commercial, if you know what you're doing, it's actually a faster vehicle than residential, potentially with lower risk, if you know what you're doing. That's going back to your original question, is that a lot of investors that are coming into commercial, they haven't studied it properly, so they do make mistakes. And with commercial property, the upside is much better, but if you make mistakes, obviously it can be quite costly.
Yeah.
So I think rather than looking at one versus the other, you're going to have to understand what is the natural progression as an investor. How do you grow your portfolio? And I think commercial becomes a natural sort of next stage.
What are some of the smaller mistakes that are very common, let's say, and then maybe 1 or 2 if there is, for the bigger mistakes that people tend to make when they cross over?
Yeah, so not understanding vacancy with commercial property, and a lot of people talk about vacancy commercial property, and that's probably the biggest risk. Because with residential, if your apartment's vacant, in a good market, it'll take you a week or 2 to lease it out, right?
Absolutely.
Yeah, you're not going to have prolonged vacancy. But with commercial property, it's not unusual to have the property vacant 2 months, 3 months, 6 months, 12 months, if you mispriced it or you don't know what you're doing. So a lot of people, they look at the headline figure, 6% net yield, fantastic, like it's better than residential, blah, blah, blah. But they don't factor into potential vacancy, because over a period of 10 years that you own the property could be vacant for 12 months altogether. So it might be, 3 months here, 3 months here, 6 months here, but you got to factor that in. And if you don't have a strong balance sheet, how are you going to carry that 6 months vacancy? Because you're still paying outgoings, you're still paying your loan.
Yeah.
So that's where a lot of first-time investors get unstuck, because they don't understand how to budget for potential vacancies and how to manage that. So I would consider that as a very common mistake that a lot of people make. And then the second one is buying something that is mispriced or it's already obtained maximum value. So what I mean by that is when we look at commercial properties, there are different subsegments. You've got office space, you've got retail, you've got industrial, you've got childcare, medical center, all that type of stuff. And each one of these subsegments or asset classes has its own supply and demand, risk and reward dynamics. And right now, there's a lot of interest in childcare centres as an investment type, because people recognise that the government is supporting a lot of childcare businesses and this and that. And childcare operators are usually pretty sticky. They sign 10-year, 15-year leases. So you buy something, you're generally pretty good for the next 10, 15 years. But what they don't understand sometimes is that with these type of businesses, if the government changes their policy, these businesses will shut down overnight. Childcare is not cheap. I mean, you've got a daughter. I don't know if she's in childcare yet or not, but in this area, you could easily pay 150, 170 bucks a day, right? And the only reason childcares are doing well at the moment is because the government subsidizes a lot of that. What happens if that gets taken away?
Yeah.
Right? People then forced to go back home rather than go to work and look after the kids, and childcare centres will come unstuck a little bit. When using childcare as an example, we typically consider childcare as the highest and best use for a lot of property types, because they've utilised both the internal space and external space. So if you're buying into a childcare centre, don't expect you have a lot more developmental upside. What you see is what you get. Whereas if you buy different asset classes, let's say maybe you buy a neighbourhood shopping centre with an IGA, maybe like sort of 10, specialty shops.
Cafes and whatever.
Cafes,
maybe a
hairdressers.
gym or hairdresser. Yeah.
Yeah, exactly. That's not the ceiling, because there's a lot more you could potentially do with that centre.
How do you mean?
So let's say we're considering buying a neighbourhood shopping centre. It's on a block of 5,000 square metres. It's got an IGA, and then it's got 10 special shops, car parking, all that type of stuff. And then what we realise is that there's actually a bit more land at the back that we could potentially put a childcare centre in, right? So you can add value by doing that. Mm-hmm. Or you might say, a couple of these tenants, they're underperforming. Maybe we can swap them out and introduce better tenants in there that are better operators, that's going to bring in more foot traffic into the centre. That's how you increase the value of the property. So that's just one quick example. So if you're able to buy the right property at the right price with further potential, you can actually grow your wealth very quickly. Okay.
So for me, our target market is, basically ambitious Australians trying to get ahead, right? And mum and dad's investors, obviously, for the most part. And, they have a home and they're trying to pull the equity out and move on to their first investment property. And what I'm hearing is commercial space is a little bit of a different breed, a little bit different mentality, right?
Yeah.
And so is there a difference in personality traits, or is that obviously financially has to be different, but what does that look like between the two?
Yeah, so when you're looking at commercial property, you have to look at it as a business, because you're dealing with business owners, the tenants are all business owners, and the way you draw up the lease, the way you apply for DAs for council, the way you maintain the property, all that type of stuff needs to be viewed through a lens of a business owner. You can't get emotional. That's what I'm trying to say. You can't get emotional about it. And there's pros and cons to that, obviously, but I think there's more pros than cons, because if you can look at commercial property as a business, you could actually make better decisions. So I think that's the first mindset.
Sorry,
shift.
just on that though, what are some of the pros and the cons so I can have an understanding?
So I think one of the pros is that because it is business, you're not going to have a lot of the residential tenancy headaches that you typically inherit with a residential property. If the tenant's not paying rent, lock them out. Done. You don't need to go through tribunal. You don't need to go through this. You don't need to give them a chance to pay back their rent. Blah blah blah. Right? They miss that rent 3 times. You serve them 3 notices. You can lock them out, and you keep everything inside the premises. So if they're heavy machinery, that could be worth a few $100,000. You keep that as a landlord, as a business owner. That's number one. Number two, the pros are, as I mentioned, you're dealing with business owners. So there's very little hard feeling. So I'm negotiating with you on the rent. You want to pay $100,000. I want you to pay $120,000. Maybe we'll try to meet somewhere in the middle. Great, fantastic. Things go on. And also, commercial property tenants usually sign longer-term leases, like 3, 5, or 10-year leases. So those are all the pros. There's more stability. But as I mentioned, some of the cons is that if you don't understand the risk associated, which is primarily to do with maintenance and sort of vacancies, and you don't have the business mindset to solve these problems or have the risk appetite, then you could get quite emotional about the investment. And when you get emotional and you make emotional decisions, that's often where people make mistakes.
Yeah. Because you're in survival mode and then you're just looking right ahead and what's in front of you to try and survive and stay afloat, rather than making a commercial decision and strategize a little bit better.
Right.
And so when you look at a commercial deal, what's the top 3 things you look at that is like, yep, that sounds like a deal?
Yeah. So I think residential and commercial, it follows the same fundamentals. It's all supply and demand. Okay. And so what does that mean? Location, building quality, and potential income. So those 3 are probably the main metrics that you need to consider. Locations will be very similar to residential. Make sure it's in a growth area, got infrastructure, happening, building quality, again, very similar. You want to make sure, you're not going to be up for massive maintenance costs going forward. And obviously the building is in such a condition that it attracts tenants rather than deter tenants. And a potential income. What can that property generate in terms of net income versus what you pay for it?
I think one of the biggest attraction for commercial space is less emotions, higher potential return, obviously. The yields are higher because it's net, right? Mm-hmm. Your tenant is paying for everything, basically. All the bills, the strata costs, land tax, all that sort of jazz. But what's usually hiding behind it? Like, what's the risk there? Vacancy you've already mentioned, but anything else that pops to mind?
That's the main one. But other risks could be, and a lot of this is property specific. If you're looking at, let's say, industrial properties, for the time being, industrial properties are typically in metro locations, in major capital cities and things like that. And a lot of these industrial areas, a lot of them could potentially be subject to rezoning. So I'll give you one example. So, one of our clients bought a property in Melbourne, and it's a $20 million sporting facility, and on the back of the facility, there's about 7,000 square meters of just vacant dirt, where a paintball, paintball facility is operating in. And there is actually an easement right in the middle of that site where the government is planning future rail line in there. So, so those type of things can, I use the word can, not always, be detrimental to the property value. You just need to understand what it means and how it impacts the value. So some of those risks need to be uncovered during the due diligence period, because a lot of these sellers are not going to advertise that. They're not going to say, "Hey, come buy my property. I've got a train line going through the back of it," right? So you need to be very diligent in looking into that. So I think a lot of the risk comes into making sure you're doing the right due diligence and making sure that you're not buying something that someone else has represented to be A, but actually B. So that's one type of risk, and then and obviously maintenance is the other risk, because maintenance can be pretty expensive for commercial properties because they're usually larger, and they're usually bigger ticket items as well most of the time. Maybe like a roller shutter door, if you need to change that could cost you 10 grand. If there's termites, that can cost you 20, 30 grand. If you need a new roof, a lot of times you can't fix partially. Sometimes you have to replace the whole roof, depending on how it's built. Especially the older factories, they have asbestos in the roof. As long as you don't touch the asbestos, it's fine. But if you do touch it, most of the time you have to replace the whole thing, right? So if it's a 1,000 square meter warehouse, that's 100 grand for a new roof.
So for us, we tend to look for properties that are kind of what the everyday Australians would be able to afford in terms of buying as well as renting, just because that's where the majority of the market is, right? We don't like to find deals that are too low because you're dealing with a certain type of people. We don't like dealing with something too high because there's a limited amount of people, and that's just not who we deal with. But is that the same case with commercial as well? Like in terms of, on a 50 to 100 square office space, you're dealing with one type of business versus a 5,000 square meters, right? Because they're completely different businesses. So what does that look like, or what are some of the risks involved, or what's the normal stories that plays out with those kind of scenarios? Yeah,
that's a really good question. And thanks for asking that, because just like residential, you've got different levels, right? One of my clients actually said this to me the other day, which I thought was pretty good insight. So before he met us, he bought a factory in Ipswich, and it's got 6 units. Each unit's roughly 150, 200 square meters. And those tenants always come and go because they're smaller businesses. So either they go broke or they're expanding.
Or they're growing.
Yeah,
because there might be a new business for first few years or something, and they realise they need a bigger space now as they've grown.
That's right. So even though he's got 6 units, on paper he's diversifying his income, but in reality he's actually got a lot of churn. So every 1 or 2 years he's got a new tenant. Every 1 or 2 years he's got a new tenant. So if you multiply the vacancies during those periods, even though he fills it pretty quickly within a month, there's still vacancy. 1 vacancy times 6 months times a period of 10 years. Plus you got your leasing costs, and you're going to drop a new lease, you're going to pay legal fees. So overall the net sort of result is actually not as good as you think. Whereas recently he bought a different type of asset. So he bought a larger industrial property, also in Brisbane, which is leased to one company. It's about 2,000 square meters, but this company's been around for like 60 years. So they do forklifts, they manufacture forklifts. And that company's been in that particular property for 30 years. So he's bought a property that has a long-standing tenant that wants to stay long-term.
Why didn't that company just buy this space? Do you think, that business, for example?
Well, it's not in their business case.
Okay.
Yeah. So that property was $5.2 million. So typically you probably need about $2 million to buy that type of property. So a lot of businesses, they don't want to sink $2 million into real estate. They would rather reinvest that into machinery or marketing or whatever. So it wasn't in their business case to own that property.
Okay.
Yeah.
And so what is a good price point that maybe not on the top end, but for the most first-time commercial investors, or not even first time, but yeah, what's a nice space? What's a nice price point?
So I think it depends on what you want to do, right? So what we do specifically is a little bit different to a lot of commercial property firms out there. We only focus on value-add opportunities. So what that means is we want to buy something for X and it turn into Y really quickly, like within 1 or 2 years. And that could be through rental reversions or subdivisions or renovations or a number of different sort of strategies. So because of the stuff that we're looking for is very specific, we find that there is a sweet spot sort of between sort of $3 to $10 million or maybe $3 to $15 million. And the reason for that is you're small enough that you're not on the radar of institutional owners like your Mirvac, Stocklands and things like that, because they typically want to buy stuff that are 20, 30, $100 million. But then you're also just big enough for a lot of mum and dad investors, which is a very competitive space in a commercial property market. So it's kind of 3 to 10, 3 to 15 is kind of the sweet spot. And, you probably need about $1 million cash or equity to start playing in that space. So it is actually quite accessible for a lot of Aussies. Especially if they've done a few residential properties, they've built up a bit of equity in their home. A lot of times they can come up with that $1 million sort of equity or cash, and they can start going into commercial properties. But that's not to say that the $0 to $3 million market is bad. There's also some really good deals that you can find in that market, but just bear in mind it is quite competitive. Because it's obviously the entry level is a lot easier. But if you look hard enough, you will find some outstanding deals in that price range as well, which you could also, value add very, very quickly.
Is it more risky because more fluctuations in price and vacancy in the 0 to 3 million?
I don't think there's a lot of fluctuation in terms of price. I think if you're buying in metro areas, I should probably say, so if you're buying metro capital cities like Sydney, Melbourne, Brisbane, even maybe even Adelaide or Perth, you're probably not going to see a lot of fluctuation in price. It's fairly stable. In the more regional areas, you might experience that. But I think it comes down to what we were talking before, it's just the quality of the building that you can buy and the quality of the tenants that you can attract. Because obviously if you have a lower budget, then you may only be able to buy maybe like a C-grade property, which have its own sort of risk and reward sort of dynamics. But typically if you have a slightly older building, then you would attract certain type of businesses that want to go in there. If you have a slightly larger budget, $2-3 million, whatever, then you could buy better quality properties in better locations, which would naturally attract better quality tenants, right?
Yeah.
And I say this quite often. If you look at commercial properties, tenant quality is really important. So I'll give you an example. So let's say you're on the same street. Let's say we're in Kogarah and we've got 2 shops next to the train station. One's leased out to a mum and dad news agency, and the other one's leased out to a government department. Maybe one of those MPs have their offices in there. Identical size, identical location, literally side by side. You would assume safely that the one that's leased to the government is worth more than the one that's leased to a mum and dad news agency because of the quality of the tenant.
Is that because of an assumption because it's safer? Because it's government backed? Is that the only reason, or why is that?
That is the main reason. So it's all about risk, right? So the risk of this person paying rent on time and the risk of this person paying rent on time is different, right? Okay. The government, you're going to get your rental income every single month on the dot. Whereas this one, depending on the business or whatever, it's higher risk. So commercial properties, a lot of times, obviously, I mentioned the location, building quality, and potential income. The quality of the tenant or quality of the potential tenants that you can attract can also affect the value of the property.
What if you can't have both? What if you have to choose between a tenant quality versus location? What would you do there?
Well, that's a good question. I think at the right location, you're always going to have a higher chance of getting a better tenant. I think that's just the fundamentals of property.
Okay.
Yeah. So, if you had to choose, I would choose the location because tenants will come and go eventually because that government department may move out eventually. And if you're buying something that's in a good location, you can find another tenant quite easily.
That's awesome.
Yeah.
Yeah, that's good. And so how do you, you talked a lot about vacancies and it could be 3, 6, 12 months. I think the first thing is how does one manage that financially as well as, I guess, expectations-wise in their mind, but also how do you actually stress test the vacancy risk?
Yeah, that's a really good question. So commercial property vacancy data is quite easy to get if you know where to look. If you go to a lot of the major commercial property firms, they do quarterly reports. You can download them for free, and they're fairly comprehensive. So let's say you're looking at buying something in Dandenong South in Melbourne, let's say, right? And you're looking for a warehouse to buy there. You can actually download half a dozen reports for free, and then you can see what they're quoting in terms of vacancy. So is it 1%, is it 5%, is it 7%, whatever. And then let's say it's a 2% vacancy, right? Then what you could do is you can actually factor in a 2% vacancy over a period of 10 years to accurately predict your cash flow. Or you might say, maybe I want a bit more buffer. Maybe I'll cater for 4% vacancy. So you can kind of put that into that. So that's number one. Number two is try to study the timing of the potential vacancies, because the vacancy is not going to be spread across the entire 10 years that you own it. It's going to come every 2 years or 3 years or 4 years, potentially, depending on your lease term. So if you're signing a tenant up for a 3-year lease, then you know that a potential vacancy will occur in year 3. And if they renew the lease, then the potential vacancy will come in year 6 and year 9, etc. So what you could do is you can then safely assume that, okay, in year 3, I better have X amount of dollars in the bank to cater for potential vacancy in case this tenant moves out. So that's number 2. And then number 3 is just look at your balance sheet as a whole. If the property becomes vacant right now for whatever reason, can I hold it for the next 6 months? Worst case scenario, can I hold it for the next 6 months? Have I got the income to support it? Have I got surplus money in the bank? Can I maybe even borrow money from some people just temporarily? Like, what are my options? So I think if you could solve these 3 metrics, then you could probably safely go ahead with the purchase.
Yeah, right.
Yeah.
What would separate a sophisticated buyer versus an amateur in this space?
Yeah, that's a really good question as well. So I personally, this is my view. Okay, I could be right, I could be wrong. My view is amateur investors, they chase the shiny objects, right? They talk to a friend, they read some article, and they go, oh, that's great. Oh, I should go for a biomedical center. Oh, I should go buy childcare. I should, whatever. Right?
Whatever's trending at the time, whatever the headlines are, whatever the growth areas are, all those things.
Exactly, right? They don't actually go deep into the research. Whereas a sophisticated investor, they will go deep into those type of research. Why is this area booming? Not saying this place is booming. They're asking why this place is booming. So they go into the fundamentals. Why is this a relevant property? And why should I consider it based on all the metrics and pricing and all that type of stuff? So what you'll find is that more experienced and sophisticated investors, they have a system that they follow. Maybe they have a template that they use to assess all these things, whereas an amateur, they don't.
Is there a quick top 3 or 5 things in the list?
I mean, like as mentioned, like the location. Obviously, that's number 1. Real estate doesn't matter what it is; it's always location. The building quality, as I mentioned, the potential income. You want to look at if you're buying something that already has a tenant, you want to make sure you study the lease, and that's a completely different topic. Because with commercial property leases, there's not a lot of limitations. Unlike a residential tenancy lease, the government pretty much says what you can and can't have in it. Commercial is a bit more broad. You can introduce all sorts of things in it. So you want to make sure that the lease is structured in a way that is more favouring the landlord than the tenant. And I could give you a few examples in a second. And then also look at the future sort of upside potential on the property as well. Am I buying the property as it is, and there's nothing I can do with it, or is there something that I can do with the property later on in 3, 5, or maybe 10 years' time? So
a lot of the fundamentals are actually quite similar to residential. It's just a little bit different view or different perspective, and I think there's just a little bit more that you can do and more potential, which comes with a higher risk, perhaps, depending if you don't know quietly. But a lot of the fundamentals you're saying is quite similar, like location, vacancy rates, tenant quality. It's all kind of similar, right?
Yeah. It is. Like I said, property, the fundamentals are the same. The nuances are obviously different. I like to compare, residential to maybe a nice sports car, maybe a nice Porsche. You can drive very, very quickly and you can get to the place that you want to get to. Whereas commercial property, you might be driving a Formula One car, right? You're going to get there a lot faster, but it's a lot more, it needs more skill to drive. And if you crash,
it's a bigger crash.
It's a bigger crash.
Yeah, sure. So what kind of commercial property would you be looking at the moment?
I think right now, again, sort of generalization, I think logistics and warehousing is what I would focus on. And there's a number of reasons. I think the fundamentals are strong for that asset class at the moment. It's a very defensive asset class when compared to retail and office and all that type of stuff. And also, it's a lot easier to understand. With warehouses, really, it's 4 walls and a roof and a roller shutter door. Whereas when you look at shopping centres, right, there's more nuance. You look at car parking, you look at tenancy risk, tenancy mix, air conditioning, so a little bit more that you need to consider. And the reason why I believe industrial properties, the warehousing, logistics, will be a good one for the short and long term is because there's a report that I read a couple of months ago. For every 100 square metres of new residential space that's built, you need about 15 square metres of logistics space to support it. So basically what that means is for every one new person that comes to Australia, you need roughly 5 square metres of warehousing space to support them. Why? Because they need groceries, they need goods, toilet paper, whatever. So, you need 5 square metres like this to support one person a year. And so as the population grows in Australia, there's going to be more demand for warehousing and logistics space. So the fundamentals are very strong for industrial. And they're typically not affected by trends, so to speak. Like, for example, 10 years ago, you might have seen all these frozen yogurt places pop up everywhere, right? And then more recently, you got all these bubble tea places popping up everywhere now, right? Yeah. Where are all the frozen yogurt places now? And where are all the bubble tea places now, right? But there's still some around, right? So they're a little bit more trend-driven, whereas industrial properties are very stable. Typically, if somebody sets up a factory, they want to stay there long term because for them to relocate all the equipment, it's a hassle.
Yeah, for sure. How much does one realistically need to do something like that? To invest in I guess specifically in the industrial space, but also I think just in general. Again, you're looking at the 3 million plus, but as a first-time investor or anyone that's looking into commercial space, what do you can't go in with 150 grand, right? Whereas you can with a residential property, for example. But What's the number as a very minimum to make it worthwhile?
Yeah, that's a really good question because it's all about trade-offs, right? I mean, yes, you could buy a $300,000 unit in a commercial unit, right? But then the trade-off is it's probably going to be in a really shitty location in the back of some complex somewhere, and you've got a tenant that doesn't pay on time, right? So it's all about trade-offs. I personally think for your sort of target audience, around $1 million is a good price point, because you've got a good balance. So you can still buy in metro areas, maybe not in Sydney so much, but you can definitely buy metro Brisbane and metro Melbourne. You can probably buy like a 200 square metre warehouse in a fairly decent growth corridor. Like, for example, in Pakenham in Melbourne, that's a massive growth corridor. You could probably buy a 200 square metre warehouse for $1 million, $1.2 million maybe. And that's going to have pretty stable growth in the medium to long term. And also, you're going to have fairly decent quality tenants that's going to lease that type of property. And then if you're able to then buy something that's under rented, let's say the market rent is $150 per square metre, and you're able to buy a property where the tenant's only paying $110 per square metre, then you can very quickly grow the value of that property, because there's a potential 40% upside on the rental income. And the good thing about commercial property is very easy to calculate value, because it's correlated to income. It's correlated to rental. So if you can grow your income, grow the net rent by 40%, all things considered to be equal, you're growing the value of the property by 40%. So if somebody had $1 million budget, and they're able to...
$1 million budget or $1 million cash?
$1 million budget.
Yep.
Yeah, if they had $1 million budget, then you could definitely buy something in the metro areas, smaller warehouse, but try to find something that's under rented, because you've got upside. If you're buying something that's already at market, you don't have that much upside. You're just waiting for the market to pick up.
How much do they need for $1 million budget? What's the minimum deposit they have to put in?
Probably about 300 to 350K.
Yeah, so 30% plus costs?
Yeah, 35% plus costs.
Yeah.
Yeah.
And what's the biggest structuring mistake you always see? Is it, are they buying in their personal name, in a trust, in a company, and yeah? Yeah,
buying personal name. That's the biggest mistake. Yeah,
Why
don't do it. Okay, so number one, if you're buying a property that's generating more than $75,000 in rental income, you have to register for GST. Okay, so you're much better off doing that in a company structure than a personal structure. Number two, you're probably not going to hold this forever. So at some stage, you're going to want to sell the property. And if you're selling it in your personal name, you're paying the maximum tax rate on capital gains tax, right? If you structure it in a unit trust or company, you're going to get some more tax, concessions by doing that. And the thing is, with commercial properties, typically you're not buying brand new, or I don't recommend buying brand new. So you're not going to have a lot of depreciation benefit anyway. So you don't need to offset any of your own personal income, because you're not going to have that sort of advantage. Most of it's going to be cash flow positive. So you're not going to have that advantage anyway. So you're better off buying in a structure that's different than your personal name.
And then you pay company tax rate instead of personal tax rate on top of the income that you're already earning from work or whatever the case may be.
Correct. That's right.
But at what point does this become a business rather than as an investment, though?
When you can replace your income or replace a portion of your income. So I'll give an example. I have a number of clients that are just full-time commercial property investors, and they typically do 1, maybe 2 deals a year, and that's it, because that's enough to feed them. They might buy a $3 million warehouse, they'll do it up, and then they flip it for $4.5 million. Minus costs, it might net them $1 million in net profit. You only need to do 1 of these a year, right? And sometimes you might be lucky, you might get presented multiple deals a year, so you might just bank it and do it. with commercial property, if you know what you're doing, you can add value really, really quickly. So you can actually turn these deals around in a year or 18 months. So I think it becomes a business once you treat it as a business and replace your income, like any business.
Yeah.
Yeah.
I'm just thinking about our clientele, like they're mum and dad investors, and it's scary enough for them to want to invest in property, in residential, even to get started, to do something, to get ahead. But it sounds like this requires more of everything: more money, more risk, more appetite, more structure, more analytics, for example. Does that mean it's not all for everyone?
It's probably not for everyone. Look, it's available for everyone, but it might not be for everyone because everyone's risk appetite is different. Everyone's availability of time is different. Everyone's life goals are different. Some people are happy to retire on 100K a year. Some people want 500K a year. It just depends on what you want. Commercial property is definitely for people that probably want a little bit more in life. They want to build generational wealth that they can pass on to their kids and maybe their grandkids. So it is for different people.
Yeah.
Yeah.
And what does a well-built portfolio look like over the next 10 years? I mean, is it more about... and again, everybody's different. Everyone's got different goals. We're talking about generalization, right?
Yeah.
But is it more of the smaller amounts times X amount of deals, or is it more a few of the bigger quality deals, and then that will be a passive income slash, depending on what your goal is. But
Yeah.
I personally don't agree with having in residential property, for example, to have $200,000 or $300,000 properties times 10. Because my analogy is like, why would you want to be carrying 10 $1 coins when you can have one $10 note or two $5 notes,
Yeah.
right? It's a lot lighter and it's a lot easier to manage than having a coin purse. So does that principle still the same for commercial?
I think so to some extent. So I think the first goal or the first objective when you're building portfolio is it has to replace your income, okay, so that you don't need to work another day in your life. Support your family expenses, you can go on holidays, live life, all that type of stuff, right? So that should be the goal. And you need to put a time frame behind it. Is it going to be a 10-year plan? Is it going to be a 15-year plan, 20-year plan, like whatever? Everyone's different. But although I agree with what you're saying, it's better to have one $10 note than 10 $1 coins. But we also have to consider how people are building the portfolio as well, because most people, or I shouldn't say most, but many people can't go straight into a $10 note right now. They have to start with a couple of $1 coins and then kind of build that. But I think once the portfolio gets to a certain size, you need to restructure it. You need to let go of some of the smaller, perhaps the two phrases that I use, either underperforming or they've hit a ceiling. Those assets need to go. If real estate were shares, you'll be trading them all the time. All right, BHP is not doing well, you sell it, you go buy Meta. Meta's not doing well, you sell it, you go buy Apple, right? It's because it's the only reason why we hold on to property forever and ever is because it's not liquid. If property were liquid, people would be trading in and out all the time, right? So I think in the long term, yes, once you build the portfolio to a certain size, you want to swap out the underperforming assets for performing assets.
Cool. Man, we're going to go into some serious rapid fire. I've got two sections. I've got a serious one and I've got a lighthearted one.
All right.
But we need to be quick, sharp, and in terms of answering these questions.
Okay.
Yeah. So, best commercial asset class right now.
Industrial properties.
Worst asset class right now.
Office.
7% weak tenant or 5% national tenant.
National tenant because less risk.
Long lease or prime location.
Prime location because you're not going to have vacancy risk.
Cool. Regional or metro?
Depends on the deal.
I want to expand more on that. But just quickly, can you expand more? What do you mean?
Well, because sometimes you can get outstanding deals in regional areas because there's less competition, less buyers.
Okay.
Right?
Cool.
Yeah.
Buy vacant and reposition or fully tenanted?
If I can buy vacant, I'll buy vacant and reposition.
Okay.
Yeah.
Fixed or variable in this cycle?
Variable's fine, I think. Yeah.
Okay. One metric investors obsess over too much?
Yield.
Okay. One metric investors ignore?
Vacancy.
And I think this one sort of already answers itself. If you had $1 million today, what are you buying?
I'll buy a industrial property in the metro area.
Cool.
Yeah.
And some quick, light-hearted ones.
Yeah.
I like these ones. So what's the first property you bought?
Oh, it was a residential. I actually bought 2 side-by-side properties in Campbelltown.
Nice.
Yeah.
Okay. Most painful lesson?
Don't buy crypto.
Ever had a nightmare tenant?
Oh, yeah.
What happened there?
The tenant turned out to be a drug lab.
Okay.
We didn't know.
Is this residential? Or commercial?
Residential.
Okay.
Residential. Yeah, it turned out to be a drug lab. The police, invaded and arrested a bunch of people, and basically locked the house for like a month while they're doing the investigations.
Oh, wow.
So yeah, I couldn't even claim landlord insurance
Why is that?
because there's criminal activity happening in the property.
Oh, my gosh.
Yeah.
Okay. You're a watch guy, so what's your favorite watch you own?
Oh, actually, I'm wearing them now. So I've got my Rolex Yachtmaster. It's black and gold. It's a little bit understated.
Yeah.
I like it, and because my logo is also black and gold.
Oyster Flex band.
Yeah,
Rose gold.
Yeah, so I love it. And then I've also got my Omega Snoopy because I like chronograph and I like Omega, and this is one of the most highly sought after Omega chronographs.
Nice.
Yeah.
What's the next watch purchase you're eyeing on?
Oof. Actually, I'm looking at a JLC Polaris chronograph, so maybe I'll get that.
Nice.
Yeah.
Okay, so coffee meeting or boardroom meeting?
Depends who I'm meeting. I like coffee meetings. People are a little bit more relaxed. You can actually read the body language a little bit better.
Can you get deals done in coffee meetings?
Yeah, 100%.
I prefer boardroom meetings.
Yeah.
I just get to the point a little bit quicker than rambling on a coffee. I mean, there's different needs, obviously. But
Yeah. It depends who you're talking to.
Yeah.
Yeah.
Worst advice you've ever heard?
Save your money.
Okay.
Yeah.
If you weren't in property, what would you be doing?
I'm
Physio, if you could have
probably-
passed.
Yeah, maybe a physio. Yeah, some sort of health related sort of industry.
One thing people would be surprised to know about you.
One thing that people will be surprised to know about me, I'm actually part Turkish.
Okay.
Yeah, so my dad's side, my grandmother is half Turk.
All right. And then finally, closing. So, in one sentence, what should investors focus on in this market?
Protecting cash flow. Because I think 2026 will be a very volatile year just across the globe because we've got wars happening, blah, 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 and all type of stuff. Don't go into too many speculative investments. I think cash flow is key, whether it's residential properties, commercial properties, or stocks and whatever. Cash flow is key, with the exception of commodities. I think gold and silver are going to be okay this year. But whatever people want to invest in, make sure the cash flow is sustainable.
Nice.
Yeah.
And where can people connect with you?
You can find me on Instagram, Will_Tong. Or you can check out my website, www.propertylions.com.au.
We'll put the links in our videos and we'll probably website and on your links as well on there. So, man, thank you so much for coming.
Yeah, no, thanks for having me.
This was fun. I really enjoyed that. I think the audience will learn a lot about the different things of the commercial space. It's not a lot talked about as much as residential, obviously. So I think we're going to get some great insights from there. And I hope you find some cool things in there. So thank you again, mate. Appreciate it.
Thanks, mate.
Cool, man.
Cool.